ASEAN fixed income market continues to perform well as of end 2019, driven by monetary easing by central banks across the region. In local currency terms, ASEAN contributed about 5.6% return, largely driven by the Philippines. Malaysia, Indonesia, and Thailand contributed about 3.2%. Central banks would now have to sail through rough economic seas, of which we would expect them to remain on a dovish tilt for the remaining parts of 2019. So in the earlier parts of 2019, we were actually hoping that the US-China trade war would come to a resolution. So that didn't happen, and in fact, what happened was we had a larger or more deeper slowdown on growth. And in that sense, over in Asia, we do see central banks across the region start to change their monetary stance. And over in the US, the job market has started to weaken, especially closer to Q2. And while inflation continues to underperform the Fed's expectations by missing the 2% target. So with that, the Fed actually has changed its interest rate posturing. From late last year, around October, we were talking about 3 rate hikes. Today, we are talking about 2 rate cuts. So that's about a 125 basis point shift. And over in the ECB, Mario Draghi has announced that interest rates would likely remain low until 2020. And at the same time, the ECB also announced that it will be extending cheap funding to banks in hope to spur economic growth over in the Euro region. Over in the UK, Theresa May resigned, and the front runner to replace her is actually a pro-Brexiter. So come 31st of October, when UK is supposed to leave the EU, it looks like it's a tall order for the UK to strike a deal with the Eurozone. In any environment whereby there's a slowdown, it is only natural for any government to enact monetary or fiscal policy easing, or both. In this sense, what the US government, or actually the US Fed did, was really to start to posture interest rate to a more dovish tilt. At the same time, we saw this with the ECB too. And over in Asia, China has really enacted its own monetary easing and some structural changes in terms of trying to boost its own economy given this slowdown, predominantly driven by the trade war that's between them and the US. And over in ASEAN, if we talk about Malaysia and we talk about Philippines, we have already seen a 25 basis point cut. And then also, I think market consensus are looking for Indonesia probably for 1 cut towards the end of the year. So if we are looking at the US market today, investors are pricing in pretty much a 2-cut scenario, which is about 80% chance. In that sense, we believe that the 10-year US Treasury would trade around the 1.9 to 2.1% range. So if you are a US dollar asset investor, particularly fixed income, I believe being in a long duration strategy would still make sense. Over in Malaysia, we have already seen the central bank reducing interest rates by 25 basis points, and we believe that this dovish tilt will continue to remain for the rest of 2019. And in that respect, would be supportive of the fixed income market over here. And over in Indonesia, if there's going to be a 25 basis point cut towards the end of the year, we do believe that there are opportunities in the fixed income market there. Over in Thailand, the 2-year and 10-year government bond spreads have tightened from 60 basis points to about 30 basis points. With no expectations of any rate cut for 2019, we do advocate a shorter duration positioning for 2019. So in summary, we do retain our long fixed income recommendation largely because of slower global growth and in effect resulting in central banks around the world keeping their monetary policy on an easing stance.